Hello, everybody. This is Brad Reed. I am a real life trader, and I'm here reminding you to be good. And by good, I mean get out of debt, achieve your financial dreams, and give generously to your community. I have the pleasure of being joined by my dad, Ed Reed, down in Austin, Texas. What's going on, Dad?
Hello, Brad. Hello, real life traders everywhere. Looks like we're in for a good insurance seminar.
I don't think anyone has ever said that ever. A good insurance seminar? At any rate, yeah, I want to talk about insurance you need and insurance you don't need because, well, I've talked to a lot of people, and a lot of people have insurance that they don't need, and they don't have insurance that they do need. So let's go ahead and jump right into it. The expensive lawyers out in California want me to remind you that this is a broad-based education and education principles. There is no way I can be specific to each and every individual that's going to watch this video or that is attending the webinar. So thank you guys for watching this. But if you do need specific advice for your specific situation, please seek a competent individual in your area. Jim Jenkins says Dale Griffith. Is that someone that logged in? Maybe so. I don't understand the reference. I know some of you guys have been emailing me or posting asking me about my influences, so I guess this is as good a time as any to, Planes, Trains, and Automobiles. Man, that was a good movie. But a lot of you guys have been asking about my influences, and a lot of you guys are right. Dave Ramsey was a big influence of mine. Susie Orman, some of you have guessed about Susie Orman as well. Steve Sikowski. Actually, my dad has been a big, huge influence. You know, in the first video, I talked about a lot of my epic failures with handling money, so life lessons have been big influences. I listen to a lot of those Saturday morning commercials where they are advertising some sort of financial advice, and I pick up some there. So, yeah, lots of different influences. Okay, getting back to the webinar. The whole point of the series is basically to get people up and going on these 4 takeaways. Success equals opportunity plus preparedness. Only by being prepared can we seize the opportunities when they come and become successful. A big part of being prepared is to have a plan. Real life traders have a plan for every single stock trade. A lot of people plan vacations, and unfortunately, people tend to spend more time on one vacation in a year, or excuse me, they spend more time planning one vacation in a year than they do planning their retirement their entire lifetime. So we're going to have a plan, and where this specific presentation comes in, it has to do with spending less than you earn. Getting the right insurance that you need will definitely help you be prepared, and by getting rid of the insurance that you do not need will help you spend less. And then, of course, retirement is spending less than your money grows plus inflation. Retirement is not a right. It does not happen at a certain age. It happens when you either are investing so well that your money grows faster than you can spend it. All right. So again, here is the plan for all of the video series. We are right there in the middle of what I call pregame. Let's get the right insurance, and then we are going to go tackle it. If you're new to real life trading, you can go over to www.reallifetrading.com, and you can see all of those things there. If you click the account button in the upper right and you sign up, we will send you stock reviews, and we'll send you stock trade with specific entries and exit points. And most of those, if not all of those, we're doing with our real money. There's also a lot of educational and free videos, kind of like this one, except on stock trading. So if you're a beginner or a seasoned pro, whether you're interested in being a long-term buy and hold investor, or if you want to day trade options, we got free videos on all of that stuff. And then there's a whole bunch of articles and videos. I picked out 2 that I think you guys might be interested in, how to choose a financial advisor, and then how to retire on 3K. And of course, there's a whole bunch more over there. And we are adding stuff all the time. So flip over there and check it out if you have not done that yet. Okay, so in this video, we're going to talk about what is insurance and what is it for. We'll talk about the insurances you don't need and the insurances you do need. And Let's talk about what is insurance. Insurance is a contract, of course, in which you pay money and then someone else says, okay, we'll take the risk, and if this thing happens, we will cover your losses. So a contract in which one party receives financial protection or reimbursement against losses as outlined by the contract. The purpose of insurance, this is part you need to remember. Protection from financially catastrophic events is what insurance should be for. Okay, the purpose of insurance, the reason or the things you want to get insurance on is to protect you from financially catastrophic events. If it is not financially catastrophic, don't get insurance on it. Okay, that's the long and short of this whole presentation. If you go and you buy a $50 electronic device and they want to send you or they want to sell you some insurance thing on it, if that $50 is financially catastrophic, then go ahead and get the insurance plan. If having to replace that $50 object would not be financially catastrophic, then do not get the insurance plan. And I'll go into more details a little bit later about how all that works. But things to consider are what is covered and what is not. How many times have you gone to collect the insurance on something and they say, "Oh, you know what? That's not covered." At one point, we got insurance on a sofa that we'd bought because we had dogs that like to jump up on the couch and figured the dog's toenails would eventually poke a hole in it. Well, it was like a 3-cushion couch, and one of the cushions just started looking really, really worn and ragged. There were no holes in it, but it just was wearing much, much differently than the rest of the couch. And so I went to collect on the insurance. I said, hey, you know what? We got an insurance plan on this. And long story short, they said, you know what? That's not covered. Tears are covered. Holes are covered. But that's not covered. So, of course, I thought, ooh, I'll just go poke some holes in it. But that wouldn't be honest. And, well, they already knew about it. So be sure you understand what is covered and what is not. Also, understand the ability of an insurance company to pay out if needed. I have also purchased, if you guys haven't seen the first video, you got to go check it out because I talk a lot about many of the silly and stupid things I did with money. But I got one of those aftermarket car insurance, not car insurance, aftermarket warranty on a car. So I bought a used car, it didn't have a warranty, and so I went and I got an aftermarket warranty on it. And sure enough, I needed an object, or I needed something repaired on my car, and guess what? That warranty company had gone out of business, and it turns out that's what those guys do. A few years ago, they were under review from the United States government, but basically their model is to sell insurances, aftermarket warranties on cars for about a year or two, and then they close that business and open up another business under a new name and keep selling aftermarket car warranties. Then they close that business and open up another business under a new name. So basically they receive a bunch of premiums and never have to pay out. So be sure you consider the ability of the insurance company to pay out if you do need it. And then also look into the deductible. I remember one time a guy on a bike rode his bike into the side of my car. This was in college, and about 4 weeks later, he graduated and left the state, but he put $520 worth of damage into my car, and I had a $500 deductible. So consider your deductibles. Generally, I'm going to tell you higher deductibles are better. If you have a high deductible, it means that you have to pay more money, but the insurance is much, much cheaper. Now, one thing that I want to point out here is that rich people have a lower insurance cost because, number one, fewer things are financially catastrophic for them. You know, if you have $1 million in the bank, you know, that $50 electronic device or whatever, or even the $5,000 TV that they get, if something happens to it, it's not financially catastrophic to rich people. So they don't need insurance on as many things. Plus, they can have higher deductibles, which means they're the things that they do insure, they pay less on it per month or per year. So that is one way that rich people pay less for things than the rest of us because they don't need as much insurance. Okay, let's go into insurance you do not need. And let me reiterate, The purpose of insurance is to protect you from financially catastrophic events. If it is not a financially catastrophic event, you do not need that insurance. So the way these insurance companies work, and this goes for just about every single insurance. I can't think of a type of insurance that doesn't work this way, but they pull tons and tons of data and they figure out the probability of something going wrong with whatever they're insuring and the cost to fix it. And the insurance company knows exactly how much it is to, or how much it's going to cost them to insure the car that you have, or to insure the house that you have, or to insure the phone that you have, or to insure the TV that you just bought. They know based on hundreds of thousands, sometimes millions of data points, how much it should cost. And I think these are called actuarial tables, at any rate. But they have all the data, so they understand how much it is, how much they're going to have to pay on average for each thing. Then they have to add in the cost to operate the company, right? The buildings, the lights and the electricity and the heating and cooling of the buildings. They have to pay their people, all that stuff. They have to tack that on top of what it would cost to provide the insurance. And then most of them just about double it. And they highly compensate the sales rep. Have you ever noticed when you go buy an electronic device or, yeah, electronic devices are the ones that come to mind. There's sometimes a salesperson that is just pushing and pushing and pushing to sell you the insurance plan on it. And they'll tell you, you know what, someone was in here just the other day and they got it home and then it didn't work, but they had the insurance plan, so everything was okay. Or, you know, their 3-year-old took a butter knife and stuck it through the TV screen, or whatever it is. They always have these stories. It's because the salesperson gets so much money for selling you that insurance plan that they get really, really pushy. And there are some places that will fire their salespeople if they don't sell enough insurance plans. These insurance packages that they sell, they make a lot of money. Can you guys think of an insurance company that's not like ridiculously rich and has a ridiculous amount of money? It's because these insurance plans pay them a whole lot of money. So that's how the insurance companies works. And here's an example. If there's a $1,000 TV that you want to buy, the insurance company may say, you know what, on 1% of these units, we're just going to have to completely replace it. So 1 out of 100, they'll have to completely replace. 3% of these TVs are going to need a $20 part. And of course they go with all the different problems that can have in the TV, how much does it cost and what's the probability. And they do all this averaging and all number crunching, and they say, okay, well, it's going to end up costing us about $10.60 per TV for us to cover it. And then they have to add in all of their administration costs. Then they have to compensate the sales rep. Well, what you get hit with is, hey, you know what, for $50 more, we'll cover the TV for 2 years. So where do you think that $50 goes to? Well, a lot of it goes to the sales rep, a lot of it goes to the insurance company, and just a tiny bit goes into actually replacing or fixing the TV. So the whole point of this discussion is to, make you guys aware that a lot of these insurance things that are on things that are not financially catastrophic, you don't need them and you should not buy them. And over the long run, you'll come out way ahead. If you're one of the folks that buys all of those insurance packages, look around your house and look at the computer that you have and the microwave and the refrigerator and the oven and the TV and the stereo system. If you bought the insurance package on every single one of those items, all of those insurance costs added up, you could probably just buy an additional item. So if you think about it, if just one of those things does need to be replaced, but you did not get the insurance plans, well, you would have that money laying on the side where you could do it yourself, and that's called insuring yourself. And that's, again, why rich people are always going to be getting richer no matter what we do, because they're very good, they're very smart with insurance, and they do not get insurance on things that are not financially catastrophic. So avoid insurance programs on TVs, cell phones, stereos, TVs, computers, all those kind of things. If you have a child that runs wild and likes to break things, if you are clumsy and drop your phone a lot, it will behoove you and it will be very, very good for you to just be more careful and for you to put things where your kids can't get them. because you cannot afford to do otherwise. Avoid insurance programs on furniture. Now, there's also a thing called a home warranty where you insure the things inside the house. It's different from homeowner's insurance or house insurance. That insures the structure, and sometimes it insures the things inside the house. But I'm talking about one of those things that's, $400, $500, or $600 a year, and if your refrigerator goes out, they will replace your refrigerator, or if your air conditioner goes out, they will replace your air conditioner. Every time I've had one of those and I've called on them, it wasn't covered. So one time, my ice maker quit working, and I called them up, and they said, "Oh, well, do you have this, or this type of ice maker?" Well, yes, I do. Okay, yeah, that's not covered. Sorry. And then one time, the garage door quit working, and I called them up, and they said, "Well, is it the box itself, or one of the springs broke?" And they said, "Oh, well, that's not covered." And so, well, basically, based on what's in the top half of the screen here is why you want to avoid the home warranty, because they know how much it should cost year after year over the lifetime to insure the devices and things in that house, and then they're going to double that and add in all their administration costs. Another package I hear a lot about is children's life insurance, and of course, when we had our kids, we got hit a lot with those. I'll talk a little bit about this later. Life insurance should be renamed income insurance. If one of your child, God forbid, if a child dies, it will be an emotionally catastrophic event, but it's not financially catastrophic. Having child life insurance does not insure the child's life. All it does is give you a little bit of money in case that child dies. So I'll talk more about life insurance later, but you should avoid life insurance for your children. And if you do have an emergency fund, and we'll talk about that in a couple of weeks, but build up an emergency fund, and that's basically your own personal insurance program. So if you do buy a $1,000 TV and it goes out, and you have a $10,000 or $15,000 emergency fund, you can go pull it out of your emergency fund. Or if your car's transmission falls out and you don't have that silly aftermarket warranty on your car, then you just dip into your emergency fund and you pay for it yourself. All right. You should have insurance on things that you are required to have insurance on. If you drive a car in the United States and most other countries, you are required to have insurance. If you have a mortgage on your house, you are required to have insurance on it in case it burns up. The mortgage company will get the money from the insurance company. The laws are going around now that we are required to have health insurance. And so I would suggest that you get health insurance. And then the last one is a little bit interesting. Your job may require you to have certain insurances. So you have to figure out if it's worth it. So when my wife got Zumba certified and starts doing her Zumba classes, she had to carry an insurance policy. And so we looked into the cost, and it was relatively inexpensive. So we went ahead and we got the insurance for her. When I started off in the financial industry as a financial advisor, if I was going to manage people's money, I would have to buy something like I think it was around a $30,000 errors and omissions insurance. Well, at that time, I wasn't even making a couple of $100 a month. So I said, no, I'm not going to do that. So be sure that you look into the cost of the insurances, because you may have to turn down a job because the insurance that they ask you to carry is too expensive. All right, and then of course, always ask yourself, would it be financially devastating if it happened? So the type of life insurance you want is level term life insurance outside of your work on the people that bring in an income and any stay-at-home parents. Now, basically, what you want to think about is if you died, how would the family continue on? How would they pay for the things that you provided? So if you're the primary income, the breadwinner for the house, and all of a sudden your income stopped because you died, what would how would your survivors continue on? Well, they would want and or need a life insurance payment that they could invest or give to a financial advisor, and then that financial advisor could then pay back as the money grows, money to provide for your family. So if you're the primary breadwinner and you die, life insurance will give your family money to live off of. If you are a stay-at-home parent, you probably want to carry about $250,000 worth of life insurance because in the case of your death, that can pay for daycare, it can for children, it can pay for lawn care or cooking and cleaning or those services that you provide can be covered by that life insurance. Now, a very key point here is outside of your work. Most people get some pretty sweetheart deals on life insurance from their employer. And those are very tempting. And if you do get those, the problem is that most people don't die at work. If you are going to, most people get a sickness or they get uncomfortable or they get some sort of disability and then they leave their work and then that's when they need the life insurance. And then when they go to get the life insurance, of course, they either have an illness or they have some disability and the insurances are much, 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 much more expensive. So avoid getting life insurance through your work. You need it from a company outside of your work. Second on the list there is critical illness health insurance and or long-term disability insurance. This is basically if you get an expensive sickness or a disability, how are you going to provide income and how are you going to provide for the care that you're going to need? And basically critical illness health insurance and or long-term disability insurance. Guys, this stuff is ridiculously cheap. Okay, if you buy it right, it's ridiculously cheap. And if you do get a really bad illness or a disability, it would likely be financially catastrophic. Now the third one there, house insurance, even after it's paid off. So if you're one of these people that have paid off your house, it's tempting to not pay $500, $600, $700, or $1,500 a year for insurance on the house because, hey, it's paid for. But imagine if you're retired and your house burns down or a tornado hits it or an uninsured driver drives their car through it or, whatever. If for some reason you have to replace your house, that may take an enormous chunk of your retirement savings to replace the house. So I would suggest house insurance even after it's paid off, because if you did have to do that, it would be financially devastating. Extra liability car insurance. I think this is very, very important for people to have much more than the minimum car insurance. And basically, what would happen if you were to drive your car into an art museum? You lost control in the parking lot or you were driving down the highway and someone bumped into you and you went flying off the highway and, in through the window of the art museum. Your car insurance will not pay for all of that. So get extra car insurance on that. I also heard a story about an uninsured motorist that hit an insured motorist. So there was a woman in a car at a stop sign, and someone, an uninsured motorist, came and rammed her from behind, knocked her car into a busy intersection. And I'm going to spare you guys the gory details, but a lot of people got really, really badly hurt. Who do you think got sued? The uninsured motorist? No, because there's no ability to pay, even though it was their fault. Yes, the woman who had insurance that was stopped at the stop sign got sued, and she lost. So we can complain about, how we have a very lawsuit-happy society, and we can complain that her lawyer didn't win. But at the end of the day, she and her family were financially devastated with all of the lawsuits and the reparations that they had to make good for. So I highly encourage you to get extra liability car insurance. It's not that much more expensive, maybe 10 or 20 bucks every 6 months for an extra $200,000, $300,000, or $500,000 worth of liability. All right, if you are over 60, this is very, very important. You want long-term care insurance. Okay, you need to get long-term care insurance. And I was looking this up. Actually, I looked this up a couple of years ago, but I assume it hasn't changed too much. The expensive policies with the perks and all of the really nice, thorough long-term care insurance policies that cost about $3,000 a year. And yes, that is a lot of money. However, if you want a nice senior care living facility, rest home, whatever it's called, those cost about $50,000 or $60,000 per year. I think the average person spends somewhere between 18 and 24 months in a long-term care facility before they pass. So if you want to spend it in a nice one, or if you want to spend it in one of those government-run ones, that could be the difference. Long-term care insurance, generally you will come out, or you can come out ahead. It's nice to have, but even if you live for 30 years and spend 2 years in one of those nice senior care facilities, you about break even. But if God forbid you go into one of those, or you need the care much earlier than 90 years old, it'll be nice to have, and it will cover it for you. It's also nice to have to protect your kids, because if you need a long stay in a retirement home and you cannot afford it, then either you get the government facility or your kids have to afford it. So I would strongly suggest you get long-term care insurance if you are over 60. And then, of course, if you're a real-life trader, for anyone, you need to learn how to get puts for your 401k or IRA or your pension, or you need to hire a competent financial advisor that can make money if the market turns bearish. Today is October 7th of 2015, and the market has been taking a bit of a bearish turn for the last several weeks. So you need to learn how to insure your retirement fund. A lot of people say their most precious, their most valuable asset is their house, and I would strongly disagree that your most valuable asset is your retirement fund. You need to protect it. You need to insure it. There's an option out there called a put, and the purpose of that is to insure your investments. So whether you want to do puts or whether you want to buy highly leveraged inverse ETFs, swing over to www.reallifetrading.com and learn how to protect your investments in the case of a bearish turn, or look for that video on how to hire a competent financial advisor, because a competent financial advisor will not only protect your money in a down market, but they will also grow the money for you. Okay, now I want to talk a little bit about life insurance, and then I'll wrap up. There are several types of life insurance out there, and it's all pretty confusing. Whole life insurance is basically you make large payments for decades, but the payout is guaranteed. Whenever you die, they will promise to pay. So if you get $1 million life insurance policy, it is guaranteed that your family will get $1 million. That sounds really cool, but you have to make large payouts. And some of the previous videos I've talked about inflation, and as shocking as this may sound, in 30 or 60 years, $1 million may not be as an astonishingly large sum of money as it is today, because the cost of living roughly triples every 30 years. So what $1 million buys today, it will not be anywhere near that value according to inflation. The next one is universal life insurance, and basically this is one that you can adjust throughout the course of your life. So as your income goes up, or maybe as you get kids, you can add to the life insurance. If you want to take away or decrease the amount that you're insured, you can do that. But basically it gives you the flexibility to increase or decrease the policy as you go along. Variable life insurance means that you can put portions of what you've paid into different investments, and this is I'm going to call it a gimmick to allow you to grow the value of your funds based on how the market performs, or based on how inflation performs, or whatever it is. But none of these are going to be good life insurance policies, because they are all ridiculously expensive. The cheapest and best insurance is called level term life insurance, and basically you make consistent small payments until the term ends. When the term ends, you are not insured anymore. When the term ends on term life insurance, you are no longer insured. So the goal is to buy a term life insurance and become self-insured by the time that term runs out. I have a 20-year level term life insurance policy on myself and on my wife. Our goal, our mission is to have as much money. Let's see, I think we're each covered for about $500,000. So our goal is to have $1 million in the bank in 18 years, because that's when the term runs out. Now, the whole point of that is if we have $1 million in the bank, the whole point of life insurance is to leave money to your survivors in the case of your death. We want to leave our kids $500,000 per parent in the case of our death. If we have $1 million in the bank and we die, then that $1 million goes to our kids. We don't need life insurance. So this is another way that rich people are able to get richer, is because they generally don't need life insurance. You know, if they were to pass, they have enough assets, they have enough money that they can provide for their survivors after they are gone. Now, these whole life, these universal life and variable life insurance have a lot of neat little marketing in them. You'll hear things like you can build cash value. It's a high interest savings account, and there's guaranteed payouts. Yes, there is a guaranteed payout. Yes, it is a high interest savings account. So if you are making payments of $2,000 or $3,000 per year, or let's just say you have to put in $5,000 per year, they're going to put maybe $3,000 or $4,000 of that into the savings account. Now that part may grow at high interest, but most of us are used to a savings account that if you put in $5,000 into your savings account, there's $5,000 in the account. The way these other things work, that you put $5,000 into the savings, into the life insurance account, and then they take their fees and they take their handling charges, and then they take their this and their that, and you're left with something much, much less, something much, much lower. So I pulled some numbers. These numbers are about a year old, but a $500,000 policy on a 35-year-old male of average health, a 20-year level term life is going to be about $300 per year. I drink less Dr. Pepper than I do now, but there were times where I spent more on Dr. Pepper than on my life insurance policy. Okay, $300 per year, that's what, $25 a month? That's less than $1 a day for $500,000 worth of life insurance. That's awesome. Now, if you do a whole life policy, that's going to be about $5,000 per year. When I had someone trying to sell me on them, they wanted $10,000 per year for life insurance. I'm like, wow. So basically, what you got to do is you invest the difference, grow it at the market rate of return, or hand it over to a financial advisor that can grow it for you, or go to reallifetrading.com, learn how to invest, and you end up getting a much larger payout because you grow the money very, very fast. Then you avoid paying lifelong fees on that whole life insurance, and you become self-insured. Term life insurance is so much cheaper than the other products. So if you have questions, go ahead and type them in. But level term life insurance is where you want to be, but you do have to work to make sure that you are self-insured, that you have that much money in investments or in the bank by the time the term ends. All right, so again, the takeaway from these series is that success equals opportunity plus preparedness. We got to get prepared if we're going to succeed financially. Have a plan. Spend less than you earn. And you can retire when you are spending less than your money grows plus inflation. All right, so the takeaways from this one. Review and update your financial mission statement that we've been working on week after week. If you do not have term life insurance, that should be level term life insurance for 10 to 20 years and somewhere around 8 to 12 times your income. Again, enough that you can take that, give it to a financial advisor, or your survivors can invest it themselves and be able to cover the services that you provided them. That's how much insurance you need. If you're over 60, you should be looking into long-term care insurance. Be sure you have health insurance, critical illness, long-term disability insurance, extra liability car insurance. Look into how much that would cost. Homeowners and renters insurance, if you don't have that. If you do not own your if you don't own your house, you rent a house or you rent an apartment or a condo or whatever, you can insure the stuff that's in your house or that you're renting or the apartment that you're renting. So if you were to get robbed and everything that's in your living unit were to be removed, you would get some money to replace it, because that would most often be financially catastrophic. And then get insurance on your retirement accounts, or go get a competent financial advisor. If you are financially successful already, consider increasing your deductibles and lower your monthly payments if you have lots of cash. All of these things will help you be more financially successful. There's a question here. Would you consider buying an umbrella plan instead of extra auto liability insurance? Niels, my family has done that. Sat down with the insurance person, and yeah, so an umbrella plan is kind of where you add on some extra insurance, and it's not specific to this car or to that car or to this house. If you have lots of different objects insured at the same place, like a lot of people get discounts on car insurance and house insurance because they insure them through the same company. Well, if you have insurance on 2 cars, a house, a business, jewelry, if you have firearms and you have insurance on all these different things, you can get what's called an umbrella policy, which says, hey, all of it, it's all together, and just tack on a certain amount of money if any single one of these things happens. And if that is less expensive overall, which it was when I sat down with the insurance person, then yes. So I think that's a great question. Thank you for asking that. I see some other people typing, so I'm not going to hit the stop record button just yet. I'm going to give people time to do it. But while people are typing, I will say thank you guys for watching this video. And for those of you that are here, thank you for being here. I appreciate it. And, oh, here comes some more typing. All right, cool. Thank you, Jim. I appreciate that. All right, guys, I'm going to turn the video off now, but thank you guys for watching. Thank you guys for being here. And as always, trade on logic, not on hope. If you have any questions, email me, Brad@reallifetrading.com.